Good morning. For Traders Exclusive, this is George Kachuk with RCM Wealth Advisors reporting to you from the CME Group trading floor in Chicago. What I'd like to talk about this morning is the markets, more specifically the economy and the markets. If you've been following us, you know I always talk about let price and volume be your guide, and that is the most important thing because the market's just an auction place where there's a balance of supply and demand, and when demand takes over, markets go up, and when supply comes in, markets go down. Okay, so one of the things I want to talk about, so the market is shaping up pretty good here now. We have the NASDAQ trading back above 7,500 level, and that's very good. S&P's above the $2,700 level, which is very good, and we're looking to see if it can take out the 2,800 level. And the Dow's trading above the 24,000 level. And the reason I talk about the economy and the markets, because as the market continues to do well, people are rattled by headline news such as trade tariffs and things like that. But one thing you need to keep in the back of your mind is that the bull market starts at the end of a recession and continues on until we get another recession. Now, right now we know there's no recession going to happen in place. And often people will say that the markets and the economy is not the same thing. And that's true on a day-to-day, week-to-week, or month-to-month basis. But over time, the markets and economy do trace each other. And the reason I bring this up is because the economy is doing a little bit better than the stock market. Stock market, we're still stuck in the trading range. Looks like we're starting to improve last week. But so one of the things is to give us some conviction is we want to take a look at some of the economic numbers. More specifically, let's take a look at the unemployment rate. We're coming into last week's numbers at 3.8%. It actually jumped to 4%. And that's just because more people got off the sidelines looking for work. However, this number tends to peak ahead of recessions. So right now we're nowhere near. This means economists expect 2019 that number to drop to about 3.2%, and in 2020 maybe even to 3%. And since our economy is made up about 70% of consumption, so all these consumers now have money in their pockets since they're working and so forth, and corporations have to build out factories to employ these people and again continue paying them. And also we can take a look at the wage growth. Wage growth came in at 2.7% year-over-year growth. And we look at total wage growth, which is average hourly earnings and the earnings growth in wages, that came in at 4.9%. And again, not until we see that peaking out, we don't expect a recession. And if we don't expect a recession, we don't think the market's going to turn down despite all the headline fears. We can take a look at retail sales. Retail sales came in at 0.8% in May, and it's up 5.9% year over year. Again, testament to the strong consumer. We can take a look at new housing sales. That came in at 6.7% for May, and it's about a 14% annualized rate. Again, very strong. And again, these numbers will peak ahead of a recession, maybe a year ahead of a recession. We can look at corporate profits. That came in at 17% year over year, last GDP report. That's $1.9 trillion in profits. So again, not until that peaks, and this is still before tax cuts have taken effect. So we expect this number to increase. We can look at truck tonnage, came in at 7.8% for May, and that's one of the strongest years, according to the American Trucking Association, they've seen. This is a very strong year, and that's moving goods across the country. Again, a reflection of the economy. Now, we still have tax cuts that haven't fully kicked in. That should give a kickstart to the economy. And again, if you're concerned about interest rates, the reason Fed is going to continue raising rates because it sees the economy growing. And not until they probably get over 5%, we're not concerned, because actually, contrary to what you may hear, stock markets do very well in the raising rate environment up until we get over that 5% level. Then it might change. But also, rate hikes, markets tend to peak after the last rate hike. And again, we're a long way away from that. So, as always, I'll say let price and volume be your guide. But if you see the price and volume acting in your favor and you need conviction in your trades, you need to think about these things in the back of your mind. Although they say the economy and the market's not the same thing, time after time, after a long period of time, they do trace each other. So have a great trading week. This is George Kachuk for RCM Wealth Advisors reporting to you from the CME Group trading floor in Chicago. Have a great week.